Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. I'm sure many of you, like me, are very keen to hear what happened in FOMC. I think broadly everyone knows that the Fed didn't hike rates yesterday, but the real cream was in the economic projections as well as the press conference, post which we had an episode of broad dollar strength. Morning, JK. I'm sure it was a long night for you. What has changed in markets' perception about rates post the FOMC?
Good morning, Swaraj. Yes, I think market has now actually coming to terms with what Fed wants to convey. That is, the rate hikes are not over in the US, and they will remain even higher for much longer. This is the message that Fed wants to give, and probably market is starting to realize that that is what is the reality. And in fact, the Fed action yesterday was not a pause, but it was a skip. It was more of a more hawkish than most expected. And while we are not going to get any relief on the rates anytime soon, it is also going to be data dependent. But if you look at the projections, the GDP projection, which is put at 2.1% versus 1% earlier for 2023, and similarly for 2024 also projected higher. With Fed also saying that economy is doing strong, and rebalancing on the employment situation is still ongoing. So they are not done with. They don't feel that they are done with the rate hikes, or rather on their mission to accomplish the 2% inflation target, and which is what Powell reiterated many times. And therefore, the dot plot itself was showing possible another 0.25% hike this year itself. And then going into 2024 and 25, the projections are higher by 0.5%, which means earlier 1% cut. The earlier cuts which are priced into 2024 and 2025 have been scaled down by 0.5%. So it's going to be higher for even longer. That is the message, and that's what the markets have reacted to, perhaps with some some delay, because the initial reaction to Fed statement was for the dollar to weaken, and then we saw move back higher in the dollar also. So overall, if you look at the economic projections on the inflation also, it is going to remain higher. So there is a twin objective of containing the economy overheating, as well as inflation going out of control. But I get a sense that Fed is very cautious about not getting into a situation of 1980s once again, that is cutting rates too soon, or stopping the hawkish policy too soon to see the second round effects of inflation. And we all know that the crude prices going up again is going to increase the inflation rate in the coming months. So therefore, we have a very clear message from Fed, and that is what the markets have reacted to. In fact, Powell's statement that if economy is stronger than expected, Fed needs to do more. So you can't have more clear message from the Fed. So everything moved with a delay on the correct side. Now, while we come back to the markets in a while, we also had contrasting situation in UK, where the inflation fell more than expected, putting doubts on whether BOE will hike the rates at all today, because this was almost a foregone conclusion just a few days back. And with inflation coming down much more than expected, both on core and the headline in UK, even providing for some of the special factors on the services side, which brought down the services inflation. Still, there are many analysts who are looking for a pause by the BOE as early as today. And so that's quite a contrast from not only what was expected from them, but also what is expected from the Fed. So Fed is on course to hike more. Bank of England possibly going to pause, and then take it forward from there after the few next day set of data comes there. In Europe as well, the debate is quite overheating on whether there will be a pause in the next meeting in December. But most of them say it depends on the economic projections that will come. So policies from the central banks are once again the main focus of the of the market. And coming to central bank itself, Japanese central bank decision, which is coming up on Friday, is going to be very key. Now there is a speculation that after the tweak in the yield curve for 10-year, which was put at 1% now, yields trading still well below that, but yen weakening 7% after the July meeting in Japan. So we have a situation where Japanese are getting more vocal on yen weakness, and there is a certain section of the market which feels that the next tweak could come from Japanese central bank by giving up on its negative interest rate policy. So they are not going to make big changes or hike rates or something like that, but this is the subtle changes that they will make and give the policy changes in a very gradual manner. At the same time, they are not happy about yen weakening so much. So that's another central bank for you. Now, as far the market reactions are concerned, obviously the yields had to show up the Fed's decision, and the 2-year yield moved to a new cycle high of 5.19%. And actually that is trying to discount another rate hike this year. 10-year and 30-year touched new 15-year high at 4.44 and 4.47% respectively. Clearly, it's a repricing of the rate path going forward. And with markets already long and more supplies of fresh papers from the government, expected yields are set to move even higher in the coming days. Now, stocks initially reacted higher, looking at the better prospects for growth in the US economy, but got pulled down by higher rates and expectation of further tightening in financial conditions. Dow Jones was more than 200 points higher on the day, but ended minus 77 points. And Nasdaq, which is more vulnerable to higher yields or higher rates, was down more than 1.5%. The global stock index was down only 0.5%, but that's because most of the markets were closed by the time the Fed decision came. But in Asia, we are seeing most of the markets are down by more than 1%. Staying with central bank, although on the EM side, it was Brazil central bank which cut rate by 0.5% yesterday, and possibly another 0.5% cut will be coming. So it's a different path that we are seeing on the EMs. Mexico is also set to cut rates in the coming month. Now, on the currencies, euro was quite strong ahead of the Fed decision, and that was par for the course, because having fallen for 9 consecutive weeks, it had to have some sort of a correction. That's what happened. And once the Fed decision was out, I think euro has broken through the very strong support to 1.063040 levels, and now it's trading just below that. I'm sure there's going to be some follow through on that, because now focus is on superior US growth, superior and higher US rates. This is going to be a big support for the dollar, which will sustain for some time. Whereas in the UK central bank decision today will keep the field open for players to react for the monetary policy, and possibly GBP looking quite vulnerable to fall below 120 in the coming days, irrespective of whether they hike today or not, because the peak in UK rates is very close by. Japanese yen, of course, will remain slightly volatile at the lower level, around 148, 148.5 levels, because there will be keenness to avoid bigger position until the rate decision is out on Friday. But the market pricing of options show that there is a good demand for yen calls rather than on yen puts. So that's some indication of how the market is positioned. Now, once again, come to rupee. Again, it is the central bank that is the focus, because if given the market forces to determine the exchange rate, USD INR would be a lot higher. And yesterday was a typical day when the market was trading close to its all-time high. Then substantial selling from PSU banks brought it down to 80, close to 83 in onshore market, and just before the Fed decision, we had even seen 82.90 being traded. Then USD/INR picked up along with the dollar index moving up, and so we have a situation in the INR where quite justifiably it should be higher, because according to RBI's own monthly report, RER is 5% overvalued. We have challenges on capital flows. Our current account deficit is being revised, expected to go up at 1.4% from 1% projected earlier because of the higher trade deficit. And we are not seeing any big performance from the exports, which remains a key sector for employment and growth. And oil prices remaining higher is not going to keep the import bill lower. All in all, I think left to the market, USD/INR should clearly break through 83.30, but I think we are not in a free market, and we should be dependent on what the central bank is allowing us to do. The two things that are also to take a note of in India: the liquidity tightness, which is at its highest, short-term liquidity tightness at the highest since 2020 at 1.46 trillion rupees, and colony rates have been inching up. This could be one more factor which can stop excessive speculative positioning in the US dollar INR. And also the other factor which may be relevant for slightly longer, broader picture, is the big decline in household savings rate in India, which is at a 5-decade low at now, and it reflects not only the income constraints and also the spending, the spending which is higher due to higher inflation, but also the change in pattern of the income earners going into other fields of investment like stock market rather than keeping money in the banks. So this is something whose impact we'll have to assess. However, as you move more money into the institutional savings, from institutional savings into the markets, it's also vulnerable when the markets take a downturn cyclically. So this is something to watch out. But overall, rupee, I think, remains vulnerable, subject to what the central bank allows. Thank you.
Thank you, JK. And a very interesting day yesterday. It seems that the rates will remain even higher for longer. Action yesterday, as you mentioned, was more like a skip than a pause, because the Fed is pricing another 25 basis hike this year based on their projections, as well as when it comes to their economy, they are projecting, stuff like GDP forecasts have been upgraded. Rate cuts, which were forecasted for 24 and 25, have been scaled down a bit. Now, if we come to UK, there is somewhat of a contrasting situation, because inflation fell more than expected by a big margin. Now even putting doubts on a rate decision by the Bank of England even today. Of course, after the FOMC, the market reaction was the yields moving higher, dollar strengthening. All of this, all the yields moving higher will have further pressure due to the fresh issuances which are happening. For rupee, substantial selling from the PSU banks led to a fall to 83 levels yesterday. But I think the global factors still remain somewhat rupee negative, as you mentioned. But because we are in a somewhat of a managed situation, a lot of direction from RBI, markets will also take cue from direction from RBI. That's it from us today. Thanks for listening. Tune in tomorrow as we discuss the latest in the financial markets. Thank you so much.